Hello, everybody. I am here with Ryan Detrick. He is the Chief Market Strategist of the Carson Group, and we are very honored and grateful for Ryan to join us today. I know you've been a busy guy with our mid-year outlook, as well as you were on CNBC today. You had a podcast going. You're all over the place. So thank you so much for joining me and answering a few questions for us.
No, I'm honored you invited me back. I'm glad to do this, Steve. And this is kind of the most fun one of the day because it's the last one. So it means I'm getting closer, but also this is always fun to talk with you. So I'm honored you had me back. Thank you, man.
Great. Well, thanks. Well, we'll dive into it so that way you can get to the après after and take care of a well-deserved hard-earned day. So, first question, obviously, everybody's talking about rates right now. So, the Fed came out a while back and said, hey, here's kind of what we're seeing. We have maybe one cut in the future. My first question is, do you think they're going to stick to that forecast?
Mm-hmm. So this year's been really interesting. At the start of the year, the market, the Fed funds futures, what the market thinks, was looking for like 6 or 7 cuts at the start of the year. The Fed never quite said that, but that was what was expected. We always said, wow, if we have 6 or 7 cuts, Steve, that's like the economy's in a lot of trouble. We said, no, they're not going to cut that many times. We were always thinking it'd be like 3 or 4. Then about 2 months ago, we were hearing, oh, inflation's higher. The Fed's not even going to cut now. Maybe they're going to hike. We said, no. The inflation data is going to get better. They're still going to cut. Well, now here we are. We got some really good inflation data recently, just last week. The stage is set, right? The Fed, you can't make any guarantees in this industry, but it's sure looking like the Fed is probably going to cut at least 2 times, September and November. But we're more open to the idea they could even cut in December as well. So we might see 3 cuts and again, it comes down for us because the inflation data continues to really improve. And that opens the door for a couple more surgical rate cuts is what we'll call that.
Awesome. Well, what do you think, what continues to be the cause of them kind of dragging their feet in this higher for longer scenario? What are the key points? I know there's a lot that goes into that question, but what are some of the key drivers?
No, I like it. Like, let's just say Jerome Powell's on the couch right here, and we're going to get in his head. Why? Why are you being so stubborn here? I think a little bit of it does have to do with, think back. I remember the word transitory. Jerome Powell used the word transitory repeatedly when inflation was high. He thought inflation was going to come right back down. Well, as we all learned, as we all lived through, that was not the case at all, right? Inflation stayed stubbornly high. So you could argue, and a lot do, and I would as well, the Fed was kind of wrong with their first initial call with inflation. So now that we have improving inflation data, Powell is being very cautious because what does he not want? He doesn't want to cut interest rates and then see inflation come soaring back. Then he was kind of wrong twice, and that's not good for his legacy. I'm not so sure if Powell, honestly, Steve, will be around all that much longer. He's been in charge since 2018. Presidency's coming up. Whoever his new boss is going to be, he might just say, I'm done. So he really probably wants to stick the landing here, avoid a recession, and get inflation back. So that's why he's being so cautious. But again, on our team, we've said for a while, I don't want to get too in the weeds of this, but we look at a lot of different components of inflation. The bottom line is a lot of things, Steve, that are negative year over year. The reason inflation has been so sticky is because of something called shelter. Things like rents and things like that have been a little sticky, but a lot of other parts of inflation data have been coming down significantly. Hotels, cars, used cars, new cars, lots of goods, some potential services as well. Keep it simple. So again, the Fed hiked rates from 0% to over 5%. We just don't think we need rates where they are now. It doesn't mean we're going to cut a whole bunch, but maybe, a couple times this year, maybe this time next year, we've got about 4 or 5 interest rate cuts. We think it'd be perfectly normal. And again, a healthy sign for this economy.
Perfect. So let's transition a little bit and talk about the markets. I know you guys just came out with your mid-year market outlook. Something I'm hearing a lot from my clients is, wow, look at how well we've got off to, this start to this year. It's been a really, really good start, which, hey, I'm not complaining. What does that typically mean for the market the second half of the year?
Yes, it has been a really good start to the year. I believe as the middle of the year is the second best start to an election year ever. 1976 was a tad better than this year. But Steve, I looked when you're just up double digits, right? Up double digits for the S&P 500 middle of the year. Now remember, your average year gains like 9%. Your average middle of the year is like 4.5%. This is a really good start on the heels of a 25% gain for the S&P last year. But when you're up double digits, the rest of the year is higher like 80% of the time. They're right around 80% of the time. They're like 83% of the time, actually. And the rest of the year is up like a median of 9.8%. Average is a little bit lower, but still better than average. So a good start to the year tends to continue to see strength. Now, one thing also that's really unique about what's been happening just kind of more real time, honest to goodness, since we've kind of released our outlook, we're seeing more broadening out. We all know technology did amazing. Communication services did amazing. The Mag 7, I know your clients probably know who we're talking about here. Those tech names did amazing. Great job with those tech names. But what we're starting to see, Steve, is some other groups take the baton. We've seen small caps, mid caps, industrials, financials, lots of other groups. We really don't want just one or two groups leading. We like the idea of this market broadening out. It doesn't mean the technology is going to crash. It doesn't mean communication service is going to crash, but we do expect the second half of this year, Steve, to see some other groups probably go up more than technology. Technology will probably still be higher. I'm not saying it's not going to be. We just think some other areas, and that's a good sign. As this bull market ages, perfectly normal to see other groups take the leadership. And honestly, again, since our outlook came out, we're starting to see that take place.
Beautiful. And so, with the mid-year outlook coming out, what is one or two key takeaways that we could gather? I know you kind of just said, hey, the market's broadening in its reach. What are some things that we can take away that you guys are seeing to kind of give us a nice lens looking forward?
Yeah, I mean, we've said, I kind of hinted at some of these. Let's put it all together. There's two big things that are going to take place second half of this year, in our opinion. Inflation is going to get better, and the market's going to realize it. The market's going to accept the fact that inflation's getting better. And what does that mean? It means there's a couple of rate cuts coming. So I know we kind of talked about these things. Those are the big themes that we have. Some of the other ones that we're looking at, if you look again at kind of the rest of the world, right? I mean, there are worries, there are geopolitical concerns. There's a lot of stuff that's going on. We still like the U.S., Steve. We still think the U.S. is growing faster than the rest of the world. We're more neutral, developed international. Think Europe, a little underweight emerging markets, not so crazy about China, but we still think the U.S. is a major cog in this, obviously, a major cog in the global economy that still looks really strong and one that simply doesn't see recession. One other thing that we see out there is the consumer. We just got some retail sales data today, the day you and I are doing this. The consumer's been left for dead multiple times, saying, oh, they're strapped for cash, there's not enough jobs. Listen, we are creating still 200,000 jobs a month. We are still seeing a lot of consumption out there. Are things perfect? No. Are there issues and concerns and worries? Of course there are. But overall, this economic cycle of growth to us still has a lot of time, led by a strong consumer, led by consumption, led by what's going to be record earnings in the S&P 500. I mean, we're not just Pollyanna, but we've been bullish, as you know, for 18 months now. When everybody was telling us there's a recession coming at the start of last year, we're still optimistic that investors, when you look back 6 months from now, are still going to be pretty happy with what happens second half of this year. And that's including what's going to be a contentious election, as we all know.
Beautiful. Well, as always, Ryan, thank you so much for your insight. We appreciate you, and go relax now. I know you've been talking all day long, so I'm sure you're thirsty.
I appreciate that, Steve. It's an honor to talk to you and help with your clients as well. Everyone listening, you guys are in good hands with Steve. I'm just honored to get the help, and we'll do it again in 6 months. I appreciate it.
Sounds good. Thanks, Ryan.